So have you ever opened up a crypto chart and been lost and confused as to what you're looking at, maybe overwhelmed by the amount of lines and indicators on there, etc.? Well, in this video, I'm going to be stripping it all back and showing you the basics of how to read a crypto chart. So let's get into it. So let's start with a fresh clean chart and go over the basics of candlestick patterns and market structure. If you're new around here and you enjoy the content, don't forget to like and subscribe so that you don't miss our future videos where we go a little bit more in depth into technical analysis and start talking about indicators. But as I say, let's start with the basics first. You first need to understand what a candlestick is and what information it gives you. So let's start with this example here. So this candlestick from Tuesday the 25th of Feb, and you can see that there are two aspects of the candlestick. You've got the body and you've got the wick, and this basically gives you all the information of what happened to price on that given day. So if we highlight it, you can see in the top left hand corner you get the information of the price point. So O stands for the opening price, which was 91552. H stands for the highest price, which was 92540. That is indicated by the top of this wick here. The lowest price of the day, or L, is 86050, which again is indicated by the bottom of this wick down here. And then finally you got the closing price, which is 84250. Now, because this is a red, the closing price is 88680. So because this is a red candle, that means that price closed lower than when it opened, as you can see by the information there. And the opening price will be the top of the rectangle here, or the top of the body, and the closing price will be the bottom of the body. Now that will be the opposite on a green candle. So if we highlight Saturday the 1st of March, for example, the opening price was 84349, which is indicated by the bottom of the body, and the closing price was 86064, which is the top of the body, because as I say, that is a green candle. Now, a live example is today's candle that you can see is still forming. So we opened up today's price at 94269. We've at some point of the day gone down to the lowest point, which was 89117. And since then we've popped up from there, which has caused the wick. Now, if we were to close the day here at 90400, that would obviously be the bottom of the body. And as I said before, because prices closed lower than it opened, that would be a red candle. So that should give you all the information you need on how to read a candlestick. So now let's go and take a look at some basic candlestick patterns. So 3 candlestick patterns we're going to go over in this video are bearish and bullish engulfing candles, pin bars, and dojis, how to identify them, and what they potentially mean for price action. So let's start with the engulfing candle. So an engulfing candle basically means that that day's candle has engulfed the previous days. So it's closed higher than the body and the wick of the previous day. And it usually can indicate a change in direction. So if we take a look at this first example down here on Tuesday, the 5th of November, you can see that price had been steadily going down on the days leading up to it. So you're in a downtrend. And then you got this bullish engulfing candle here on Tuesday, the 5th, which indicated a potential change in direction because buyers have stepped into the market. They've engulfed the previous day's price action. And as you can see, that is exactly what happened. We went on a big uptrend, similar to here on the 27th of November. So price had declined from the 22nd leading into the 27th of November. And then we got this engulfing candle that you can see far exceeded the previous day's red candle. And then price continued to go up. Bearish engulfing candles, you can see 2 nice examples here are Tuesday the 7th of Jan. So again, we're in an uptrend from the 31st of December up until this candle here, which engulfed the previous day's green candle. So it implied that sellers were stepping into the market and they had a change of momentum, which led to prices going lower. And then the next example is here on the 31st of Jan. Again, small uptrend from the 27th of Jan leading into this candle here, which engulfed the previous days and then led to a long sell-off. Now, of course, this isn't 100% accurate. If it was that easy, then trading would be very, very simple indeed. It's not a case. It's just something that can give you a clue as to what might be happening and use that in conjunction and confluence with other factors. So the next candlestick pattern we're going to talk about is the pin bar. So this can be used as a sign of a reversal after a long trend and can be used for both bullish and bearish. So the first example we've got is this bearish pin bar here. So this ended the trend which had started, as we talked about before, from the 5th of November. And you can see that how to identify a pin bar is a long wick, which is at least twice the size of the body, which is going to be very small. And you can see that represented some exhaustion in terms of buyers. So you can see we had a wick on the previous day, which got sold into, and then another wick on that day on the 17th of December, formed the pin bar. And that told you that there was a good chance that this move was exhausted and that we were going to potentially see a reversal, which is exactly what happened. The same thing happened, but in reverse on the 28th of February, just a few days ago. Again, we had this big downtrend which started on the 21st of February, or you could even say started all the way back on the 31st of Jan. But locally, the trend started on the 21st of Feb. We had the big sell-off on the 23rd, 24th, 25th. And then you can see we had this big wick down here on the 28th, zip back up, small candle body, big wick, which is way more than twice the size of the body. And it indicated that that may well be the end of the seller exhaustion, and that buyers have stepped back into the market to reverse the price, which is exactly what happened over the next couple of days. So they're two good examples of where you might see a potential change and reversal in price action. Now let's take a look at when you probably, or when the market is giving you the indication that you probably want to stay on the sidelines and not want to take any positions because the market is undecided, which can be reflected in what's called a Doji candle, which you can see 4 good examples of here, where you may get wicks either side, but the candle bodies are very, very small, which indicates, as we mentioned before, that the candle price has closed very close to the opening price, which means that price isn't really going anywhere. It's moving around during the day, but when it comes to the close, it's closing very close to the open price. So it's very undecided. The market is undecided, which, as you can see, it was for a very long time. Even though the following candles weren't Doji candles, you can see that price didn't really move outside of this very small range. So as I say, if you start to see this on the chart, you probably want to step out and not touch anything until you get a clear break in one direction or the other. So talking of breaks into one direction or the other, let's talk about market structure and how to identify it. So in terms of market structure, the market is typically doing one of two things. It's either in a trending environment or a range-bound environment. Now, trending environment is basically where price is consistently going up, which would be an uptrend, or consistently going down, which would be a downtrend. Or range-bound environment typically means that price is bouncing between two areas and more or less going sideways, depending on the time frame that you're on. Now, we're currently on the daily time frame, which means that each one of these candlesticks represents the price action for one day, whereas we're actually going to take a look at the 4-hour time frame, which means that each one of these candlesticks represent the price action for a 4-hour period. So let's take a look at how we can identify which environment price is in. So uptrends, downtrends, and range-bound environments, and how you can use that to your advantage. So here we've got a pretty up-to-date example of what a downtrend would look like. Now, what denotes a downtrend is lower highs and lower lows. Now, what do I mean by that? So you can see we made a high here at $96,000. Price then dropped considerably down to $87,000 before having a small bounce. So that's our low. So that started off with a high, then we made our low, then we've come up, we've bounced, and we've made a high here, which is lower than the previous high. So that makes it a lower high. We then dropped down into a new low, which again was lower than the previous low, which makes that a lower low. We then repeated the pattern, came up, made a high, which was lower than the previous high. So it's another lower high. We then dropped, made another low, which was lower than the previous low, making another lower low. Now, this downtrend was invalidated when we made this 4-hour candle close here at midday on Sunday, the 2nd of March, because we closed above the previous high, which meant that we were no longer making lower highs. Now, an uptrend is the complete opposite. So let's take a look at an example of an uptrend. So as you can imagine, an uptrend is where we're making higher highs and higher lows. So this example, we made a high here at around $95,000, came in and made a low at $89,000, and then we reversed and we put in a high which was higher than the previous high, therefore being a higher high. We also made higher lows here as well. So you can see we bottomed out here, which was higher than the previous low. We then came up, made another high, which was higher than the previous high, making a higher high. Dropped down, made a low, which was higher than the previous low. So it's a higher low. and then finally one more higher high, one more higher low, and then we did actually go on to make another higher high up here, up at $109,000. However, we did also make a lower low down here, which some people might have thought invalidated the uptrend, so because this was lower than this low here. However, it's not always going to be that easy. There are going to be some fake outs along the way. We did ultimately then go on to make a higher high, and it was technically higher than this previous higher low, so there was a chance you would have stayed in the trend and ignored that. But you can see the general trend is obviously up, making higher highs and higher lows, which you can identify. Now, in terms of our current day example, we could be switching from a downtrend into an uptrend. As I say, we have already invalidated the downtrend by no longer making lower highs. We've actually closed above that previous lower high. Now we've come up and we've made another high up here. So you can see we've made this high up here. Now the question is, are we going to come down, hold this level of support and make a higher low, which, as we just discussed, is the components of an uptrend. So that higher low would obviously be higher than this low that we've put in here. So there is a chance that we are now going from a downtrend into an uptrend potentially, all depending on the close of these 4-hour candles. So you don't really want to see if it's going to be an uptrend. The 4-hour candles needs to put in a low here, which will be a higher low, and not break below $87,000. So we'll see how that progresses over the coming days. Now, in terms of a range bound environment, a very quick and easy example of that is this range bound environment here. So you can see that price was not closing above or below this price point here until we started our trend. So basically no 4-hour candle closes above $99,500 or below $94,000. So price is typically just bouncing between these two levels, not making any significant higher highs or higher lows or lower highs or lower lows. It's just bouncing in between two price points, and if you zoom out, it basically looks sideways. And there's a big difference between what is happening in this time period as opposed to what's happening in this time period. You know, pretty obvious. This is just going sideways, whereas here, as we've just discussed, you can clearly see that price is going in a downtrend and then potentially back into an uptrend. So hopefully you found that useful. Drop in the comments below what you're struggling with when it comes to charts, and we'll get a video on it. As I say, don't forget to like and subscribe to see our future videos as we go a little bit more in depth and talk about some indicators as well. So hope you enjoyed. I'll see you on the next one.